being public about it would lead to, getting targeted.
Basically a war zone.
But now we're seeing kind of that being formalised for the first time.
Great example, isn't it, of the complexities of tender negotiations.
But in 2018, they reached 186 million sales.
And for a shipper, I'd say the game's going to change between now.
Welcome to the Freight Debate, the ultimate destination for supply chain professionals, logistics leaders, and anyone who's ever wondered what really keeps the world moving. Back today here, Phil, for our last episode in this round, so please you can join me and we can round the year off with the last episode.
Hello, Emily. We've covered a lot in this first season of the Freight Debate, end of the year, as you say. So let's finish off this first series of the podcast, which has been really successful, with a bang. Got a few things to cover, some familiar friends in terms of topics on the Freight Debate, and we've got something that's a little bit different as well. So we'll be covering latest in the Red Sea, which has been kind of obviously a recurring theme. We sound the tariff klaxon again for the final time in this season of the Freight Debate, and we'll also cover Christmas lights, which is a really appropriate way to sign off for the year ahead of the festive season. Suez Canal then, Emily, first topic. Been some interesting developments in recent weeks, but you're going to focus on the kind of battle of the comms, I think, aren't you?
Yeah, because in reality, there haven't been that many developments. Now, there's a little bit of forward motion on CMA's front, perhaps unsurprisingly to our listeners here, but we had this big kind of palaver around it, I would say, after Maersk had a meeting with the Suez Canal Authority, and the authority put out quite a optimistic press release, shall we say, of Maersk partial return in December, CMA even a full return, and a couple of days of like, is this carriers really saying that they have enough guarantees that they're willing to return? And the answer was basically no. That yes, this had been discussed, but there is no fixed timeline. Maersk was out to say it. It also put out a release with its alliance partner Hapag-Lloyd that they also didn't have any concrete timetable to return, and CMA basically refused to comment. So not the kind of, I think the Suez Canal Authority they obviously want container ships to return. We talked, I think, back in May. They started offering a 15% discount for the largest of container ships. That wasn't enough, and I think it's clear that economic message isn't going to be enough, and carriers are still kind of having that wait and see in terms of committing to any kind of return, all bar CMA.
Yeah, I was speaking to our chief analyst, Peter Sand, earlier today, and he pulled up a chart showing container ship transits, and they're actually if anything, they're trending downwards. So it's not even a case of kind of, you might think it's kind of ticking up slightly. If anything, it's trending downwards. But it's also worth pointing out, isn't it, that we're talking specifically about container ships here, because other vessel types and commodities are actually kind of ticking up in terms of transits through the region, but we are specifically talking about container shipping here.
Yeah, and even more specifically, we're talking about kind of those major east-west trade lanes and the top global carriers that we talk about a lot here. There is still container ships going through. So when you look at the numbers in the Suez Canal, you can see, okay, we're far down from where we used to be, but there are still 60-ish ships going through each direction every day. Even, more specifically, we have container ships that are still going through, right? What we talk about mostly here is those major east-west trade lanes. It's top global carriers, and it's the largest ship type. If you look at the statistic, you still get a much smaller than previous number of ships going through, but they are still transiting. But you can also see the average size of container ships transiting has also really, really come far down. So there's plenty of ships going through, plenty of little container ships, but just not what we are talking about. We typically, when I'm trying to demonstrate this, I would pull up a map and say I only want to see container ships over 8,000 TEU to kind of highlight this point.
Yeah, it's interesting though, because you talk about the comms battle there. And comms is going to be an interesting one, isn't it, I suppose, because when carriers do return, they're going to want to make sure that their customers are aware that they're returning. But at the same time, part of me thinks that if I was going to start sailing back through what's basically a war zone, I probably wouldn't want to do so to great fanfare. Do you know what? You probably wouldn't want to kind of put it up in lights, as it were. You would want to kind of test the water, literally, and do it in that way rather than a big kind of,
I think if you are worried that, being public about it would lead to, getting targeted, then it probably is too early for you to really think about making that return, I think. So that will definitely come, but I think that they will want something more than just what we have on the table at the moment.
Yeah. So let's just very quickly on Red Sea and Suez. How are carriers approaching this? Because we've talked about the kind of battle of the comms here with CMA and Maersk saying, or certainly Maersk and as part of Gemini saying there's no real kind of time frame yet. But we are seeing some carriers test the water, aren't we? Particularly CMA CGM.
We're seeing CMA CGM, and that comes as no surprise, right? They've been sending container ships through every now and then on the backhaul legs, so that's important, right? It's when you're sailing back from Europe to the Far East, you have far less cargo on board, all those kind of things, and a lot of those still with assistance from the French Navy when they go through. But now we're seeing kind of that being formalized for the first time. So they're announcing that on one of their services, and it is actually an Ocean Alliance service, the NEU4, they are going to change it so that the service rotation now includes a backhaul trip through Suez. So it'll sail around Africa up to Europe, and then it'll sail back through the Suez Canal. And that's the first time we've kind of seen it happen on a specific trade. And with our new sort of the EC data sets that we now have available, we can see, okay, that looks at, if you're looking at the round trip times, that cuts it from about 105 days to 98, I think it was. So that's about a week this gets taken off. And it frees up one ship. So that, we talk about kind of the return to Suez, unlocking a lot of capacity that's being absorbed. One service going one of the ways back through Suez gives you one ship. So there is an awful long way to go. But this might also be kind of the first steps in CMA kind of testing the waters and seeing how far they can push it. And actually, you also have another milestone, which was they sent through their first sort of ship on the front haul leg. So the other way, going from Asia to Europe, Asia into the Mediterranean. I don't know, Phil, if you'll catch the reference. It was a ship called CMA CGM Jules Verne, who wrote a certain book about a trip around the world.
Yes, it's Phileas Fogg. Was it Phileas Fogg? Around the world in 80 days?
Exactly. And I think that 80 days is a more manageable trip if you can go through Suez rather than around Africa.
Yeah.
I'm not sure that's why, but that is also a milestone we're seeing, that first front haul trip. Again, they haven't committed to anything on there, but they are kind of the carrier that seems to be willing to test the waters a little bit more gradually than while other carriers look more locked in their positions.
Yeah. I mean, just to be clear, we don't work from a script, do we, Emily? And I didn't anticipate having transit times for Phileas Fogg 80 days around the world cropping up, but it's more than welcome.
And I think so that kind of, because we talk often about a kind of return to the Suez Canal and the full scale return. But it is very possible that we get, there's a possibility that we get some kind of agreement there in the Middle East that means all carriers are saying, we now think it's safe, let's go. That's a possibility. The other possibility is we kind of get it more gradually and we see this happening. And the ports arguably would find that easier, because then you don't get all the ships suddenly arriving and all that congestion that we've talked about a lot, I think, here, but you kind of get that time to sort of build it in. For shippers, it's maybe a bit trickier because suddenly you're dealing with one service that has this transit time and another that has much less, and you're kind of having to figure it out on a service level. Yeah. But it is possible. And then we talk about kind of this return to the Red Sea and the press release and all the other stuff that went on last week. And for a lot of shippers who are tendering, they're suddenly thinking, hang on, I'm tendering for 2026 rate. Am I again going to end up in a situation like I was in 2024? I just signed my rate and the situation changed. Now, for some, the answer to that is indexing. I don't think we need to spend more time on that today. That is an option. For others who don't look at that, they might be looking to say, actually, let me utilize this Red Sea surcharge. And I think we say at Zanetta all the time that the all-in rate is what's really important. How it's broken down is not necessarily the most interesting thing. But if you can get that Red Sea surcharge into your 2026 rates, and you need some kind of definition for when can we remove this surcharge. And that, of course, depends. Is it when half of services of this carrier is going through Suez, or is it when half of all, there's all sorts of different ways you could define it. And I think defining that would be really important as we see kind of these different potential strategies to return. But that would offer you a way to then say, okay, we now have whatever we have defined as a return to Red Sea. Let us remove these $300-400, whatever it is, from our rate and benefit from what we expect to be a much lower market.
Yeah, and it's a great example, isn't it, of the complexities of tender negotiations and tender strategies, because it would be quite easy, wouldn't it, for a shipper to be entering tender negotiations right now and have 100 things on their mind. But if they're tendering for the next 12 months, Red Sea, it's highly likely something's going to change in the next 12 months, isn't it? So you can't kick that can down the road, can you? You've got to deal with it in your current freight strategy, tender strategy, because otherwise you're going to kind of be in a straitjacket, aren't you, for the whole 12-month period, unable to remove what would otherwise be a Red Sea surcharge if it isn't explicitly stated in your contract what the Red Sea surcharge relates to, or even how big that Red Sea surcharge is in the proportion of the Red Sea surcharge in the all-in rate.
Yeah, no, exactly. And you can look at it in different ways. You can say, okay, we want a renegotiation clause if the market average drops by X%, or, there are different ways of doing that doesn't involve that surcharge. But it is one of those examples where, okay, when the first surcharge is first being put on, and that is you've got your rates, but carriers won't move your volumes unless you pay them this extra surcharge. That's, of course, sort of not great for a shipper. But if you can say, well, it should also work the other way, and find a way to work that out. But again, you have to have kind of very clear definitions of when this is then triggered. And that's where maybe actually saying it's a Red Sea, but it gets triggered when rates have moved by a certain percentage, and then maybe you don't call it Red Sea, you just adapt that way. And carriers, as we're seeing in tender rates, they are competitive, those tender rates. Carriers want your volumes. So maybe you pay $200 more now, but you have that extra surcharge included. That means 6 months down the road, you can get $500 off your rate. That is probably worthwhile, right? So there's different ways of doing it, but it's just something really important to consider.
Yeah, absolutely. And just before we move on, actually, you mentioned that ports might prefer the kind of gradual approach. One thing that kind of comes to mind, even from shippers, is that maybe they would prefer it as well if we're talking about rates, because the short-term congestion as services realign to go through Suez rather than round Cape of Good Hope, is that port congestion, as we saw mid-2024, can cause the rates to spike and delay shipments and all that kind of stuff. So maybe there's an angle there as well where shippers actually might want to see a more kind of stable, gradual approach to the return. You just need
a good, not obviously we want to promote Zaletta, but you need something with really good data that is telling you, okay, this service has now been changed. I can now count on this service calling, doing a different transit time, and then all those different. You really need to understand, okay, what is my ship? Where is my cargo on which ship it is, and what is that ship doing? Is it going east or north or south to Suez or around Africa?
Wonderful. So that leads us nicely on to the second topic for today, which is carrier tactics. I would encourage anyone who's watching or listening to this episode of the Freight Debate to go to the Zanetta platform, because Emily's written a really great blog on this, which will provide some really good background, context and reading for the discussion that we're going to have. And, it does lead us on quite nicely from the Red Sea. And as you say, as ships return to transiting the Suez, it's going to kind of release capacity. I know that's probably not strictly true, but for the purpose of this discussion, release capacity or certainly add to the problem of overcapacity in the market for carriers. And you looked into how carriers are actually approaching this situation and the kind of different tactics that they're adopting between certainly long haul, front haul trades into US and Europe and the transatlantic. So would you mind telling us a little bit more, Emily?
Yeah, so I think my interest was triggered one day logging into the platform. You could see year-on-year comparisons in the capacity deployed. And I was looking particularly at trades into the US from the Far East. And there was a difference because Far East US East Coast service or capacity offered was up by 35% from a year ago, which is huge when you think about we've got kind of these 9% demand drops in September, which is the latest data we have on demand. So 35% up into the East Coast, and yet the West Coast was basically flat, almost down 2 or 3 percentage points, which was a bit surprising given that actually these trades both have relatively similar developments on the spot rates. And we were looking kind of at carriers treating these two things more equally than what these numbers would suggest. And the reality is the difference is not that great between the two. They are working in the same way. The problem is what we're comparing to last year. And it feels like a long time ago that we were talking about port strikes on the US East Coast, if we remember back to then, right? That also in November, which is when we ran the comparison, that was still impacting lower capacity numbers into the US East Coast. On the other hand, that was having higher capacity into the West Coast. So you already have this higher base of capacity you're comparing to year on year. And then we see a little bit also that kind of we're seeing the US East Coast is less exposed to China than the US West Coast. And that means that those services that call Far East to the US, they call China, they'll also call other countries in the area, are seeing slightly smaller drops in demand, which also impacts it. But The kind of main take from this is carriers are offering a lot of capacity when you think that demand is down 9%. And they're continuing to offer a lot of capacity, even as rates are falling. Now, we're recording this sort of 2nd of December. Our indication suggests that rates went up slightly on the 1st of December as those GRIs came through. Whether it's not a huge increase and whether they will stick is yet to be seen, because we've seen previously in recent times that hasn't worked. But what it seems to indicate at the moment is carriers are adding more capacity in the face of lower demand and in the face of spot rates that are down by 50% from last year, which really suggests they're going for market share far more than they're interested in keeping the rates up. Of course, in the perfect world, they'd have both, but at the moment, that market share seems to be winning over.
So yeah, it's a really interesting one, and it's a really difficult one, is it not, for shippers to kind of play the game. And I use the word game because what carriers are doing now is, are we fair to say, clearly directed at Europe, because European shippers are generally going into tender season. Like a football match, I use the kind of analogy, you might start the game playing a certain way, but as the game evolves, you might throw on a striker if you're getting beat, or you might throw on some defenders if you're winning. Carriers are going to adjust their tactics as well, aren't they? So as we get into 2026, we're kind of entering that period when US shippers really kind of focus on tenders for new contracts. We're going to see carriers maybe change their approach to capacity onto the US trades as well.
Yeah, and I think, for the US shippers, they've obviously got an awful lot on their minds at the moment for tariffs, but it's probably about enjoy it while it lasts at the moment when it comes purely to kind of securing capacity and what freight rate you're paying. You mentioned Europe. What we're seeing there is slightly different, and actually it's split between North Europe and the Med. Into the Mediterranean, we're seeing carriers adding capacity and rates are still rising, not fast, but quite solidly, whereas into Europe, capacity is a little bit flatter, and rates are also basically flat, depending on how that last December data starts coming in at. But there is also the big difference. Of course, we're saying carriers are prioritizing Europe as they go into tenders with European shippers and they want to kind of secure their base. But there is also the huge difference, and that's the demand picture. So we don't have demand past September, but what we see and what we can kind of work out logically is that Far East to US demand is down by a lot, whereas Far East to Europe demand is actually proving to be quite robust even now into the end of the year, which is also obviously helping. So it's kind of two things that compound to make the differences even starker than they might otherwise be.
Yeah, and again, this is another. So in fact, it's the last episode. We could do shameless plugs for Zanetta in the last episode of the season. It is about having that data, isn't it? Because you can. It is amazing, and I think you can see it in the blog. Actually, I think we pulled out some charts, didn't we, to show the shift in capacity on these trades. And when you see the capacity developments against the rate developments, it is, even to a kind of, I'm not an analyst, but it's really clear, isn't it, that what's actually going on here. And for a shipper, as I say, the game's going to change between now and maybe February, March next year. So it is a case of always having that continuous visibility of what's going on in the market, and not just on the trades that you're shipping goods on, but also the transatlantic. If you're a shipper on the transatlantic and you see carriers shifting vessels off services on the Transpac onto your trade, it's going to have an impact, isn't it? And vice versa. If something happens next year and there's another black swan and capacity gets taken off the transatlantic back onto the trans-Pacific trades, then again you're going to see rates go in the opposite direction, aren't you? So it is a global
and that goes
for
basically all the secondary trades, right? We picked transatlantic in the blog, but it's the same. We saw it very obviously from Far East to South American East Coast. We see it all sorts of places when carriers don't need ships on this main trade, they get put elsewhere. We've seen it with trades into Africa, suddenly seeing some of those largest container ships being deployed. And as you say, right, you can be purely a transatlantic shipper or purely Far East South America and not be bothered about what's happening in the rest of the world. But you don't actually have that privilege to just say, I don't care, because it is going to impact you. Those ships can be moved basically. I mean, of course, there are restrictions in terms of port size and who can handle what, but basically anywhere as carriers try and shift around and find trades where they can make money. Yeah,
well, it's an amazing example of that, isn't there, from early this year when we saw, in the immediate aftermath of Trump's tariffs, we saw the demand kind of fall off a cliff into the US and capacity increase on trades into South America, wasn't it? Far East to South America, not kind of impacted theoretically by the tariffs. Then we saw the tariff lowered, the US-China tariffs lowered, and then we saw this kind of capacity shifting back onto the Transpac trades at the expense of the South America.
And that was when spot rates rose 250% 50, 60%, I want to say.
Crazy. Yeah, it was way over 200%, wasn't it? A spike of over 200%, Far East to South America, East Coast, because of tariffs, US tariffs, which shouldn't really kind of come into it, should it? But it does.
It's not quite that simple.
No, it's not. Never is. Well, if it was that simple, Emily,
we wouldn't be here.
We wouldn't be here, would we? And thank God you are. Okay, which leads us very nicely onto the last topic of the last episode of this season's Freight Debate, and it's a really nice way to end it off, which is Christmas lights, because we are quick approaching Christmas.
December, we can no longer push it away, I think. We have to succumb.
My Christmas lights are now on the front of my house, so it's officially Christmas, and we can say so.
And have you pegged for somebody with Christmas lights? But surprise every day. Anyway, quiz time for you.
Are you calling me like the British Grinch here or something, Emily? Because it certainly sounds like it.
No, so one of these goods, and actually this one goes back to the first trade war we had in Trump's first term, looking at how this trade shifted. But before we get there, Phil, want to guess how many? Technically, they're called Christmas tree lighting sets. If you want to go through the HS codes, how many of those does the US import annually?
When? Now? As in this?
The peak was in 2018. I had to say last year was far below that. I was almost a third. So you have quite a big range there.
Okay, I will say 60 million.
Not far off. So last year they had 67 million. But in 2018, they reached 186 million sets, which is a completely ridiculous number of Christmas tree lighting sets. But
so we can gain from that people in America like Christmas tree lights.
And in theory, it's something you can reuse, so you shouldn't need to buy new ones every year, which is presumably why it's fallen. But the vast majority of those came from China, perhaps not unsurprisingly. And then this was one of the goods, if you remember back then, we didn't get these 20% tariffs on total imports. They were lists of what goods were getting hit, and these lights was one of them. So the vast majority, I think it was 85%, came from China, and the rest from the rest of Asia. What we saw basically in 2018 and 2019 was a complete shift, and it took 2 years, but it happened, where Cambodia suddenly jumps off. So it goes from having about 5% of total US exports of Christmas tree lighting sets in containers coming from Cambodia to now 75%. And that's a huge difference. Now, I don't think they're the hardest thing to manufacture. Presumably it's not sort of a hard thing to do. It's one of those things you can quite quickly change. Whether it's fully that, whether it's a little bit of transshipment or a combination of both, we see really clearly that that's what the trade war did in the first place. And that was 20%, 25% tariffs. And we know what the tariff levels are today. They're much higher than that in many cases. But seeing very clearly, it's not that they suddenly started producing more lighting sets. There was this shift towards Cambodia. And this year we're trending on for much lower levels, which is also not completely unsurprising. Not completely surprising, rather.
Yeah, if I put my cynical hat on, is there a decent light? I mean, it's a massive shift, isn't it? It's, this isn't a kind of gradual kind of phasing from China towards Cambodia. This is a clear and obvious kind of mass transfer. Would that happen so quickly? And to shift manufacturing in that way for a specific type of product? And if that is kind of difficult to see, is it possibly also a case that these products are essentially being shipped to the US still from China, but via Cambodia? I don't know.
I think it's probably a combination of the two in reality. But I would say also, we've had that push, and if we forget about the trade war for a second, from China, that they want to focus on kind of those high-end manufacturing goods. They didn't want to be doing the simple stuff. And we're looking kind of for cheaper alternatives to reproduce. I would assume that these Christmas tree lights are in that kind of simple stuff that China thinks we actually want to be the level up. So they probably weren't too sort of reluctant in handing that over. Obviously, hugely accelerated by the trade war, and how much of the shift is transshipment versus actual is hard to tell. But I think again, back then we were only talking about tariffs on China, and it was a long list of goods for sure, but it was certain goods, it wasn't everything. So you had a little bit more maneuver you could pull on. We talked a lot about Vietnam at the time, we still do that today, but also Cambodia and these other examples coming through.
Yeah, so it is really interesting that when you talked about those more robust volumes into Europe as opposed to the US, it's a nice way to round off this season of the Freight Debate because it's Christmas. But it does kind of, it's also a really symbolic one, isn't it? Because does it kind of set the scene for these shifting trade patterns into 2026 because of these tariffs? And the other thing that I'd kind of put to you as well is that we've talked about sweeping tariffs rather than product-based tariffs like in 2018 with these Christmas lights. But even so, it is still going to target or affect certain industries and products more than others, even if it's just a blanket 20%, just because of the margins that are on certain products. So again, we're always at pains to say that, experiences vary, but they absolutely will vary, won't they? If you're a shipper of a low margin product for a consumer product into the US, you're going to experience this very differently from other industries, aren't you?
Yeah, and I think, Christmas tree lights, it's kind of an obvious commodity that if times are tough and the budget isn't going as far as you want it to go, it's not the first thing you go out and buy. Maybe you go down to the cellar and spend an hour untangling the ones from last year, rather than going out because they're suddenly $10 more expensive or $5 more expensive, whatever the case may be, right? It's not, so it's one of those, another indicator that actually we're going to see lower imports this year as well. And that is also because we're just seeing changing demand. The consumers aren't willing to spend that much more money on lighting sets. Yeah,
and you can't imagine there's going to be Christmas light factories being opened up in the US to kind of fill that void. Okay, wonderful. So Christmas tree lights.
There might be good deals for you if China is looking for alternative markets now, or even Cambodia with those tariffs. They can't send them to the US. They might be selling them cheap in the UK.
They're working.
If you need new ones.
Well, yeah. I mean, when you do take them down from the attic, I did test them and they're working. So maybe next year, my Christmas tree lights will add 1 unit to the what was it, 67 million into the US.
Yes, into the US.
59 million.
Doing your bit for container shipping.
59,999,000 and whatever it may be, 999. There you go. I've offset one of them. Okay, wonderful. Thank you, Emily. And not just for this episode of the Freight Debate, but for all of the episodes of the Freight Debate in this first season. It's been hugely successful. We've seen viewing figures increase and grow, subscribers increase and grow. It's been amazing. And at the Zanetta Summit in Barcelona, lots of people listen. We know lots of people listen to it and they find it really interesting and they find the insights that you provide really valuable as they kind of try and navigate this market. So thank you very much, Emily, for
thank you, Phil. You've been here just as much. Might be taking a break here, but there'll still be plenty of content coming out on the Zanetta website, blogs and all sorts of fun stuff if you need your weekly hit of container shipping news.
Who doesn't need a weekly hit of container shipping news? But you're absolutely right. There'll be webinars, and Emily's every 2 weeks. Emily will post a blog on the Zanetta website, and that will continue. So please take a look at that. And in the meantime, please also hit subscribe to the Freight Debate so that when we do fire up the engine again, or the propellers again on the Freight Debate, you'll get an alert to know that the discussion has started again between myself and Emily. But other than that, everyone at Zanetta and the Freight Debate, myself and Emily, would like to wish you all very Merry Christmas and very happy and healthy New Year, and all the best for 2026. Thank you.